So where we left off on the valuation of Starbucks is we had taken the historical income statement, balance sheet, and cash flow data from Bloomberg using their standardized format, and we had created a forecast of 11 years of financial statements for Starbucks, which gave us 11 years worth of economic statements of Starbucks, both historical and 11 years of forecast. And there's one step that is a little bit more technical that we also have to complete using this model. And it has to do with the balance sheet of the standard format in Bloomberg. This tab, called Data BS, is the balance sheet, Data IS income statement, Data BS balance sheet, Data CF cash flow, the standardized formatted balance sheet that Bloomberg has given us. Unfortunately, there's a couple of items that we need that are on the balance sheet that Bloomberg puts into a section called reference items. So when you export data from Bloomberg, in addition to their standardized financial statements, at the bottom of their statements are what they call reference items. Reference items primarily are coming from the footnotes of the 10Ks and the 10Qs, right, where a lot of important data is placed by companies, the tables of the footnotes. Or if they've summarized an item, they'll put some of the data they've summarized into the reference item section. Right? The challenge that we will have with the reference item section is that the reference items differ by company. And the reference items that they put into the reference item sections don't always show up on the same row. So the statements are standardized through total liabilities and equity, but then once you get to reference items, they're not standardized across companies. So in our model, in our assumptions tab, I didn't talk about this on Monday, but there are 3 items from the reference item section that we will need in our model. Right? And they're not always in the same place. Right? So when we created the income tab and created the balance sheet tab, we could always go to the same row in the data that was exported from Bloomberg, and we could always reference that row because every time we export and put it in, we knew the data was going to be in that row. Unfortunately, for these reference items, they don't always occur in the same row. So what we're going to have to do is a manual process, but we're going to have to take these 3 items from the reference item sections, if they exist, and put the data here. So that way our model's always looking for this place for goodwill. Our model's looking in this section for pension obligations. And our model's always looking at operating leases, which is an off-balance sheet item, here as well. Okay? So those are the 3 things that we're going to use for the reference item section that we'll need to put in the assumptions tab. Because in the assumptions tab, it will always be in these 3 rows. Where in the reference items, it will change by company. So here's what we have to do. It's a manual process. But on the balance sheet, we'll come down here to goodwill, which in this case happens to be on row 65. And the way I have it set up on the assumptions tab is it actually matches the format that the most current year is on the left when Bloomberg exports the data by default. So all we have to do is take the goodwill, take all of the goodwill numbers, copy it, go to the assumptions tab, paste special values. And that will be Starbucks goodwill. Okay. Now again, the reason why we're paste special values is because we don't want to have references to the original cells. So we're just copying over the numbers. So that's why I don't copy paste. Right? So pension obligations. Same thing. Come up here, pension obligations. Now for Starbucks, it's easy because they're all zeros. So they're already zeros, so I don't have to change anything, except that number was a 0. right? And then finally, operating leases. When we subtract the debt to get the equity value of a company, we have to subtract all what threes really represent are debt and what are called debt equivalents. Right? So anything that is a return on what was originally expected, so implied interest or actual interest, is considered a debt equivalent. Right? So basically, on the balance sheet, the company will list its debt, but off balance sheet, the company will list its operating leases. So that's where the reference items come in. So in the reference items, Bloomberg has gone through the footnotes, and it has totaled the operating leases for a company, which you can see for Starbucks are pretty substantial, $4.6 billion last year. So again, I'm going to take these operating leases. Now this is the one area of the valuation where we're actually making more of a guesstimate. Actually, I just need the current operating leases. I don't really care about the historical. So actually, that was just 45.76. And here's what I mean. This actually represents 5 years worth of non-cancelable leases that come from the 10K. And ideally, what we want is we want a present value of just the principal on the lease. Because by definition, an operating lease includes both the principal and the implied interest. Right? So what we'd want to do is we'd want to strip out the interest and we want to present value it. All right? But with one number for operating leases, we can't really do that. So basically, this is going to be the one proxy that we're going to do because this isn't the true present value of the operating leases. This number is probably a little higher than what that number would be, right? Because we want the present value of the principal. So again, when we subtract out the leases, we're subtracting out sort of a notional value of the leases. In an ideal world, we would have wanted to get the present value of the operating leases. Right? So because Bloomberg doesn't give us a year-by-year number, it's hard to figure that out. They're just giving us one number. We would have to actually go to the company's 10Ks to get a year-by-year number. We'd have to estimate a discount rate for the leases, and then we'd have to figure out what that present value is after we stripped out the interest and looked at the principal on the leases. It's a complicated process, so I'm just saying this one's a proxy. Everything else is going to be more specific to the actual numbers. But at least it gives us a general idea of the operating leases. Because again, what's going to matter for Starbucks is we already said that from a shares outstanding standpoint, Starbucks has approximately 756 million shares. So if you think about it, if they have $4.5 billion worth of operating leases, that's somewhere in the range of, what is 445 divided by, call it 8, around 6 something a share. Somewhere between $6 and $7 a share is the amount of liability associated with these leases. So we would misprice Starbucks if we didn't treat these leases as a cost that would have to be paid before the shareholders got refunded. So that's why we're putting it on there. Okay? And like I said, this is a proxy of what the present value is, but at least we know we're going to be somewhere in the ballpark. Okay? Just letting you know about that one. All right, so I've put these numbers in, and now what I'm going to do is I'm going to, and again, the model is a series of tabs. I'm going to add a new tab to the model. So if you're following along, add a tab. And I'm going to call this tab the DCF Valuation. So this is the discounted cash flow valuation tab of Starbucks. And when we were going through the lecture notes last week, and we're talking about the process for valuation, I mentioned the Home Depot example in the book, where the book had done a valuation, a discounted cash flow valuation of Home Depot, right? So what we're going to do is we're going to use this as our roadmap to do the DCF valuation, right? Because this is actually the process for the valuation. All right, so I'm going to set up this tab to look a lot like this. So when McKinsey did the Home Depot valuation, they had forecasted the operating value, the free cash flows of Home Depot. So we need a forecast for free cash flow going into the future. Well, coincidentally, we have one of those. On our CFI, we have forecasted free cash flow into the future. So what I really need to do is I need to take those free cash flow forecasts and put them on that page. Now, specifically what I'm going to do, just so it all fits on one page, is I'm going to put the years in column A heading down. Relative reference. So the first year of the forecast from CFI is 2014. It's the first forecasted year. Equals that plus 1 all the way down to 2023. Okay, and again, I'm using relative references for the year, so if I ever adjust my model, that I can always change that reference. Right? And I just happen to reference it there. I could also reference it off of the Assumptions tab, off that last reported year. And then just make that plus 1. So I either choose the first forecasted year or last reported year plus 1, but I need the first year of the forecast for free cash flow. And then what I specifically need next is I need my free cash flow forecast for each one of those years. Right? So equals, from my CFI, my 2014 free cash flow. And I'm going to format this column to currency, 1 decimal place, just make it easier to see. 2015 free cash flow off my CFI. 2016 free cash flow. 2017 free cash flow. 2018. 2019. 2020, 2021, 2022, and 2023. Okay, so again, HIJKLMNOPQ. All right. Now, you'll notice that we had actually had a forecast for 2024, but I'm not using it. And the reason I'm not using it is because 2024 is going to be the first year of our continuing value period. Right? So the first 10 years are the defined value forecast, where we're forecasting year by year. We always forecast 1 extra year in our forecast to have that final year be the beginning of the continuing value period. So 2024 is the beginning of continuing value. Right? Make this a little bit bigger so it's easier to see. All right, so what I now need to do is I need to discount these free cash flows. So I'm going to use the concept of a discount factor. And a discount factor is the present value is the cash flow divided by 1 plus r to the power of t or n. And so what I'm going to do is I'm going to multiply the cash flow times 1 over 1 plus r to the t or n. Okay? So basically, a discount factor is take 1 divided by 1 plus the r, in our case, is the cost of capital. And again, I'm just going to cut this down to 4 decimal places. And when I copy and paste this down, I always want it to refer to that cell. So I'm going to put a $sign in front of the B and a $sign in front of the 4 to make an absolute reference. I'm going to copy and paste this down. So for the first year, 1 divided by 1 plus r. For the second year, 1 divided by 1 plus r to the power of 2, which is shift 6, 2. 1 plus r cubed, power of 3. Power of 4, power of 5, 6th power, 7th power, 8th, 9th, 10th. So again, 1 plus r squared, cubed, 4, 5, 6, 7, 8, 9, 10. So my discounted free cash flow equals the free cash flow times the discount factors. Again, I'll make that currency 1 decimal place, copy and paste that down. Right. So basically, column B says this is the free cash flow, the operating value that we are forecasting, assuming our financial statements come true for Starbucks for the next decade, given a cost of capital, which the market was estimating at around 9%, 9.1%, the discounted free cash flows are here for the next 10 years in present value. Okay? So what I'm going to do is I'm going to sum those, and that's going to give me the operating value for first 10 years of Starbucks. So that's how much value they're creating by people coming to their stores, buying their products for the next decade. Again, assuming our financial statements come true. Ever see what I just did? Questions about that? Pretty straightforward. Basically, what they did with Home Depot. Same exact process. Right? Now, we're not going to do the mid-year adjustment factor. Right? We could, but in the real world, very few people do. So I'm going to skip that step. You're welcome to always include that step, but for simplicity, I am going to skip that step. So now what we're going to do is we're going to take the continuing value of Starbucks from year 11 going into perpetuity. Okay. So actually I'll put this right here. So the continuing value, and there was a formula for that in this week's lecture notes, this week's reading that I didn't really go over, but I assume you read the book. It is the key value driver equation. So basically, to do continuing value, we said we were going to use the key value driver equation, which is the rearranged growing perpetuity formula. Okay? So we need 4 things to do the key value driver equation. We need no plat in year T plus 1. That's the 2024 no plat. That's why you do the extra year. Okay, so the first year of the continuing value is the year that we're using the no plat for. We need a long-term growth rate in cash flow for the business. We need the RONIC, which is the return on new invested capital, or think 2024 ROIC, and we need a WACC. Those are the 4 things we need to do the continuing value equation. Now, what I'm going to do, because I might want to change some of these assumptions later, is I'm going to make sure that those 4 items are in the Assumptions tab. So we already have a WACC, so I'm going to add in a continuing value no plat. I'm going to add in a continuing value RONIC, or RONIC, and I'm going to add a continuing value G. I'm going to make those yellow. My continuing value no plat is my 2024 no plat. That's going to be on my TII. No plat, 2024. These need to be currency. My continuing value ROIC is my 2024 ROIC. Now here's the important part. Based on BOY, or beginning of year invested capital. So I have two tabs for economic profit, EPBOY, EPEOY, end of year, beginning of year. What I need to get this valuation right is to use the beginning of year ROIC. So on the EPBOY tab, there is a return on invested capital for the firm. There's a before and after goodwill. So I always want to do after goodwill when I do my valuation. So after goodwill, return on invested capital is this number. It's a crazy 260% number. And I need a continuing value long-term growth rate. I'm going to use 3%. So the continuing value long-term growth rate is basically the growth of cash flow of Starbucks forever. So the idea is Starbucks is primarily a U.S. company right now, even though they have international business. And so what I'm going to say is long-term, they're going to grow 20, 30, 40 years from now at about the rate of a mature Western economy. So in this case, for the last 100 years, the U.S. has grown at about a 3% compound annual growth rate of GDP. And people expect in the next 100 years, it's going to be somewhere in the 2 to 3% range. So I'm going to use 3% as a starting point. Right? But that's what I want. I want the long-term growth rate of the company. And most companies are going to be tied to the economy of the businesses that they're in. So I want the long-term growth rate of the economy as my proxy for G. Now, I know mathematically that my G, because cash flow divided by R minus G is the straight perpetuity equation, my long-term growth rate can't be above my cost of capital. So it's going to be bounded by my cost of capital on the top end, and typically 0 at the bottom end, although you could theoretically have negative growth into infinity. But in any event, usually between 0 and cost of capital is what you're bounded by. So practically for most companies, 0 to 6%, because again, what we really want to do with this continuing value formula is value the company once they are mature. So when they're mature, they should be growing relatively close to the economy. When they grow relatively close to the economy, probably more like 3%. Right? If I were doing a Chinese company, an Asian company, I wouldn't use the 7 to 8% current growth rate of China. Right? Because in 30 years, China's not growing at 7 or 8%. Just law of large numbers. So I might use for China 4%. Right? Maybe 4.5%. Right? Possibly 5 at the top end. But again, when you deal with law of large numbers, that's what I said, you want something to be more mature, and eventually China's going to look like the U.S. Might take 50 years, but it's eventually going to start growing at about 3%, like most historical developed countries. Just because, again, the economy gets so big. So, again, I want a longer-term growth rate. So I wouldn't want to use an 8% growth rate for an Asian company. I'd want to use something probably a little bit slower. Different if I were valuing a Thai company, right? Because those markets might take a longer time to mature, so I might use a 6% growth rate for Thailand or something like that. Again, adjusted by the nature of the business. So in this case, Starbucks, more US, a little bit of Europe. I'm going to call that 3%. Okay? We can always change it later. That's my starting assumption. So here's the key. On my valuation, I need to take this formula and put it into my model. And the reason why I put everything in the assumptions tab is just it's easy to build a formula with it all in one place. And I can always change it later if I want to change any of those assumptions. So, put in the formula in, equals, left paren, from the assumptions tab, no plat times left paren, 1 minus the continuing value growth divided by the continuing value RONIC, right paren, divided by left paren, the WACC, minus the continuing value growth, right paren. So that is the value of Starbucks into perpetuity from year 11 forward. Except I need a present value. So I need to bring it back to today. Because right now, this is the value as of January 1, 2024. And I need to bring it back to today, where I'm valuing the business as of December 31, 2013. So here's what I practically need to do. I'm going to use the same discount factor as the 2023 one, and then I'm going to multiply to basically get a present value of the continuing value. And you might think, well, gee, why didn't I add another year for the discount factor? And the answer is because the perpetuity formula already includes a discount factor, and therefore it's discounting 2024. So I don't want to double discount 2024. Common mistake people make in finance, but that's why I'm not discounting 2024. Because 2024 is already discounted by that formula. So that's why I just need the 2023 discount factor to bring it back to a present value today. So what I'm saying is that the operating value of Starbucks is the sum of those two items, or, assuming my forecast is true, approximately $52 billion. So that is the value of Starbucks running its stores. Now, to my operating value, going back to the Home Depot example, I need to add in my non-operating items. Right? Now, back to this. In TFI, we had already listed the major non-operating items from the standardized statements in Bloomberg. Here they are. Excess cash, non-operating assets, net of non-operating liabilities, long-term investments, and long-term receivables. So, those are the three items I need for my twos. Now here's the thing. If I use the last reported year, which is 2013, these are already in present value, because this is the current amount outstanding for each one of those items. So what I'm going to do in my valuation is I'm going to use, from the TFI, the 2013 last reported numbers for each one of those three. So that if I take my ones and my twos, I get my enterprise value. My enterprise value is the operating value and the non-operating value. And that would be my enterprise value forecast for Starbucks. Right? Now, one potential adjustment that I might make is one of those non-operating assets that Starbucks or another company could make could be an equity investment in another company. For example, I think we talked about Yahoo. One of Yahoo's smartest investments is they bought a piece of Alibaba. So the book value of Alibaba on Yahoo's balance sheet is relatively low. It's what they paid for it. And the market value of Alibaba is very high, and it's not recorded on the balance sheet. Because the way that accountants handle the balance sheet is that if you buy an investment in another company, you report it at the book value, but if the market value goes up, you don't report the going up. You report the going down if it loses value, but you don't report the going up if it gains value. So accountants are very conservative about that. But if I'm valuing the company, I want to have a realistic value for the asset. So here's the other thing I'm going to do. I'm going to put in my assumptions, something called a price-to-book multiple of investments. And right now, I'm going to make that price-to-book multiple 1. And I'm going to take my DCF valuation, and I'm going to take my non-operating assets, and I'm going to multiply that by the price-to-book multiple. Right? So here's why I'm doing this. So let's say Starbucks owns a piece of another business, and that business is worth 5 times what Starbucks originally paid for it. Then what I could do is I could come here to my assumptions, change the price-to-book multiple to 5, and in my valuation, I now have a market value of those non-operating assets that is more realistic to what it would be worth. right? But if I don't know what it is, I can undo that change. I at least have the book value. So what I have is likely to be a floor to the non-operating asset value, but I don't have a ceiling. Because again, I know that the accountants will write it down if it's lost value, but they don't write it up if it's gain value. So at least on a conservative basis, if I put the book value in, I have kind of a minimum value for the non-operating assets. So I'll at least leave the price to book multiple of 1, but theoretically I could change it if I actually knew the value of the non-operating assets. But I'm at least putting in a recognition that we want to check that. Questions about what I just did? All right, so enterprise value equals debt and equity. So enterprise value minus debt equals equity. So what I next need to do is take everything that is a debt or debt equivalent and start subtracting. So again, this is where TFI helps out, because on my TFI, I have listed all of the non-common items. I've listed retirement-related liabilities. I've listed TFI interest-bearing debt. I'm solving for common, so I don't have to redo the common. I have my preferred stock, and I have my minority interest. Those are the 4 items off my TFI that have to be paid off before there's cash to be paid to the common shareholders. So again, I use my 2013 actual values, TFI, 2013 retirement, if they have any, Starbucks does not, and interest-bearing debt, and preferred stock, if they have any, off of my TFI, and minority interest. Those are the balance sheet listed 3s and non-common 4s, right? Except, this was the other one. Do they have any other liabilities that have to be paid that have interest associated with them? Well, operating leases. This is the liability that's hidden. This is the liability that's not on the balance sheet. So I need to make sure that this is also something that has to be paid before the common shareholders can get paid. You got to pay the leases. These are the non-cancelable leases. So therefore, what I'm going to do is I'm going to take my operating leases and I'm going to list those as a liability as well. And then I will get my common equity value equals my enterprise value minus the sum of this. Next, on my assumptions, I'm going to need a shares outstanding to get a share price. So I'm going to put this on the assumption page. And the reason I'm going to put this on the assumption page is the shares outstanding will change by company. Right? So I want to quickly be able to change it if I change the company that I'm valuing. So in this case, in Bloomberg, I mentioned the screenshot to get the shares outstanding is the DES screen. Stands for description. And very quickly on there, you can get the shares out. 755.9. So 755.9 million. That's this number right here, shares out. All right, so DCF valuation, shares outstanding equals that number, forecasted share price, common value divided by shares, 67.53. So if all those assumptions come true, I'm at $67.53 a share. By the way, Starbucks was at 74 on Monday. Some $7 of their current share price. Not that far off. That's if they just keep repeating 2013 in the future. Obviously, the market thinks they're going to do a little bit better in the future. Questions about what we just did so far? Yes?
I have a question about the enterprise value. So previously we learned it is actually the market capitalization plus the market value of debt and minus the cash. So
Market cap here plus the debt here.
But the debt, isn't it the book value of debt?
This is book value debt.
So should we
Except we're adding in the operating leases. You got to add in the leases too. So this is debt. So I'm just saying market cap, forecasted market cap, plus debt equals enterprise value. Right? However, keep going. Then what did you do? You took this minus what? Minus that,
yeah,
which really is what?
it's the enterprise value for acquisition.
Enterprise value minus cash is what? What would we call it in this class? This minus that is that. It's operating value. So what people have taught you is total enterprise value. I would actually say is more of the operating value because it's the debt minus the cash. Net debt plus equity value. And we would call this, because we're using the absolute Modigliani-Miller model, we're saying that Modigliani-Miller would say that's the operating value of the firm, plus a couple of other miscellaneous non-operating assets. But since most firms don't have much in the way of non-operating assets, cash is usually their biggest one. And again, when these theories were developed, the textbooks were written, you have to remember, the textbooks were written in the 70s. Chicago started this. Everything you're learning today started in Chicago in the 70s. I went to Wharton in the late 80s. So my professors at Wharton came from Chicago. And the textbooks that were written by the Chicago people. They went to Wharton, they went to Stanford, they went to Harvard, a couple went to Columbia, NYU. Then they wrote the textbooks that we're using today. What I'm telling you is in the 80s, when these textbooks were written, companies didn't have a lot of investments in other businesses. It was really when the tech industry and the biotech and healthcare industry started making lots of investments into other companies' minority stakes in the 90s that really started to become much more prevalent. So I'm telling you, when the textbooks were written, that you're being taught total enterprise value. The only non-operating asset for the vast majority of companies out there was cash. So that's why the short definition that is used in the world today for enterprise value is enterprise value minus cash, which Modigliani-Miller would call operating value. So I'm not saying that the world is wrong. The world uses that term, and that's what you're taught in other classes. But what I told you here today is what I told you a couple weeks ago. I said you're going to understand people take shortcuts, or when people make adjustments, what adjustments they're making. And what they're really adjusting to is what's called operating value. That's what you learn total enterprise value is. So don't go telling your other professor you're wrong. Because that's the definition that's actually used. If you look up Bloomberg, that's what Bloomberg uses for enterprise value. So if I go to Bloomberg, just as an example, and I look up Starbucks, which I'm at Starbucks, and I type in FAEV, which gets me to my enterprise value analysis to Starbucks, here's their definition of enterprise value. Market cap minus cash plus debt. Equity, debt, minus cash. It's what you learned. So that's what I'm saying. But in this class, we would call that operating value. So what the rest of the world is trying to call enterprise value, it's really the operating value of the business, or at least a proxy for the operating value of the business. That's why, by the way, the key value driver equation works for valuing a company. Because what they're calling the enterprise value, we're really using the key value drivers to do the operating value, and that's a proxy for what they would call the enterprise value. Right? So again, we could rearrange our model very quickly to give a valuation doing the same thing. Right? But I'm just sticking clean to the original Modigliani-Miller model. So that's what I'm saying. When we do our valuation this class, I'm teaching you the theoretical Modigliani-Miller valuation. Get you the same answer. You can reshuffle it if necessary for your own purposes. But that's how you would map to what you learned in the other class. That makes sense?
And also, another question
Sure.
about the debt, should we consider the market value or just
Ideally, you want the market value. Because basically, you're going to pay it off at the market value. So we are making a number of assumptions. One is that the interest-bearing debt trades at par. So the companies that we're going to value this semester, none of them are going to default. They all are investment-grade credit ratings. So realistically, their book value is going to be the amount of payment that they're going to make. But if we were valuing a distressed company, like a JCPenney, which has a terrible credit rating, then we would probably want to use the market value of the debt, which is below book value, because there's a good likelihood of bankruptcy built into that debt risk. Because I think their credit rating is like C plus or triple C plus or triple C minus, which infers like a 40% probability of default. So their credit rating alone tells you that the market doesn't think that they're trading at a reasonable rate, which means their debt's probably trading at a huge discount. So I'd use the market value of the debt. So that would be absolutely right. Same thing, that's what I was talking about, market value of the non-operating assets we'd want to put in there. And in an ideal world, we'd want to do the market value of the preferred stock. If we could figure it out, the market value of the minority interest. If we could figure it out, the real value of the operating leases on a present value basis. But because we don't have easy access to that information, we'll use the book values as a proxy. Right? And what I'm telling you is the reality of the Wall Street crowd is the Wall Street crowd is going to use Cap IQ and Bloomberg. So they're going to use the same data that we're using, and there's a couple of them that will do the extra homework, but a lot of them will be lazy, and they're just going to use the book values just like we are. That's why I said you're going to quickly see that this model will get really close to company stock prices. And again, we can make adjustments. So that's the point. Like Stern Stewart, for example, when they talk about economic value added, they make up to 300 adjustments to do EVA. But practically, 300 adjustments gives you a Frankenstein. All right? It doesn't really give you an EVA. Like there's just too many adjustments because then you don't even know what number you started with. So what I'm saying is the same thing is true in valuation. Like there's probably 5 or 6 core adjustments you need to make, and we're not making all of them here. But we probably could if we really wanted to do this for real for a company. But once you start making too many adjustments, then you just make too many assumptions. That's the other challenge you run into in the real world. That's why people simplify things like enterprise value. But good questions. Other questions? All right. Next, we're going to do an economic profit valuation. This is your final exam, by the way. So on the midterm exam, you have to convert the statements. On your final exam, you have to take the forecasted statements and show that the two valuation methodologies get you the same answer. So if I go back to lecture 2, we talked about the economic profit or EVA valuation of a company. And what we said was the only difference between the DCF and the EP valuation was that in the EP valuation, we changed how the operating value was calculated. Everything below operating value was the same. So here's what we're going to do in the model we're building. If I go back to Excel, I'm going to clone this spreadsheet, clone this worksheet. Take the DCF, move or copy, create a copy, put it at the end. So I have DCF valuation 2. I have a copy of the worksheet that we just created. Then what I'm going to do is I'm just going to rename this the EP or economic profit valuation. Okay. So right now my EP valuation tab and my DCF valuation tab are identical. What's different about economic profit? One, instead of forecasting free cash flows, McKinsey forecasted economic profits. So that's what I need. Instead of free cash flow, I need economic profit. Instead of discounted free cash flow, I have discounted economic profit. Spell it out for you. So I got to wipe that out. So where's my forecast for economic profit? EPBOY tab. Again, I'm using BOI, beginning of year, because I want the two valuations to exactly equal each other. If I use end of year, I get close. If I use beginning of year, I get exact. That's why we're using BOI. So, economic profit after goodwill, final row, 23. I need my forecast, starting with 2014. So G23. So back to here, 2014 equals, make sure to do the BOI, 2014 economic profit. And let me just make it a little smaller so it's easier to copy and paste. 2015. 2016, 2017, 2018, 2019, 2020, 21, 22, and 23. So G, H, I, J, K, L, M, N, O, P. All right, same cost of capital, same discount factor, discounted economic profits. So what I really have here is I have the change in operating value for the first 10 years. So again, economic profit is the one period change in value, or EVA, same thing, one period change in value. So what I now have is the forecast for the change in value for the first decade. And I need the same thing in continuing value. I need the change in value into perpetuity. So it's a slight revision of this formula to do the continuing value economic profit. Basically, the formula that they derived in the book that we're going to use is this formula. That's the formula for continuing value of economic profit. So we have to put that formula into our model with the correct order of operations. This is the hardest part of building this model, getting it to work. Right? So, how do I know it's going to work? The final part, so I'm going to do that last. The final part of the EP model is I take the change in value for the first decade, the change in value in continuing value, and then what I do is I take my beginning or starting invested capital, and I add those three together. So how much capital do I start with? How much value do I add or subtract in the first decade? How much value do I add or subtract in year 11 into perpetuity? That's basically the framework for the economic profit valuation. So the third item I'm going to need is my beginning or starting invested capital. That is my, from my TFI, my 2013 invested capital. So when I sum these three numbers, I need to get the same value as that number. Those two have to be equal. Right? If they're not, then I made a mistake. So I can already tell you that I could back solve for this number, but that's not an acceptable answer in this class. You actually have to get that formula right. So here's what we're going to do. We're going to solve for the continuing value. So put this formula in. First part's easy. Economic profit divided by WACC. So I'm going to need in my assumptions continuing value economic profit. So I'm going to do it all off that one page. Equals EPBOY 2024 economic profit. So I have the 5 items right here that I need. Back to my valuation. Equals, left paren, economic profit divided by WACC, so just on my assumptions page. The continuing value economic profit divided by the WACC. Plus, left paren. No plat times left paren growth divided by RONIC, right paren, times left paren RONIC minus WACC left paren divided by left paren WACC times left paren WACC minus growth. I get growth in there twice. Right paren, right paren. I think I have it right, but I don't know. We'll find out. Hit enter. Calculated without an error, so that's good. Here's the question. 52, 365, 15. 52, 365, 15 equals that operating value calculated using the discounted economic profit methodology minus that calculated using the free cash flow methodology, difference of 0. Not difference of $1. Exact. So that's the point. If you use beginning of year invested capital in the calculation of ROIC, you get an exact match between your EP valuation and your DCF valuation. It's just rearranged equations. That's why we're doing beginning of year invested capital, because I wanted to be exact. I wanted to show you the equivalence. If we use end of year or average of the year, we get close. Right? The only way it mathematically works out exact is if you use the starting. So that's why we use beginning of year. So again, I just wanted to prove that to you in the class, and that's what you're going to have to do on your final exam. So just recreate the operating value using the other method and show that they match. But here's what we know. Starbucks started with $1.2 billion, and they added almost $51 billion worth of value to what they've actually invested as of today. Okay. Most of that comes in the out years. And that's the important thing to remember too, is that a lot of Starbucks share price is going to be sensitive to what happens in year 11 going forward. That's why that continuing value equation, those 3 variables, 3 or 4 variables that go into continuing value are so important. Slight changes in growth rate, huge impacts of value of the company. Slight changes in ROIC, huge changes in value of the company. Slight changes in profit, huge value in the changes of the company. Slight changes in WACC, huge value in the changes of the company. So that's why I'm saying 2/3 of the value of Starbucks is continuing value. And that's true for most big companies. That's why even when quarterly earnings get adjusted, people go in, the analysts go in and adjust their templates. They're adjusting a little bit around the margin, but when you amplify that out through a continuing value period, it has huge impacts on the stock price. That's why a slight change in growth can destroy the value of Twitter right now. Because even a 1% compound annual growth rate could probably explain all the difference in Twitter's drop in stock price when they announced earnings 2 weeks ago and they didn't meet expectations. That's what's playing out in the real world. Questions about this? All right. So I'm going to save this as part 2. And now what we're going to do is we're going to move towards what we call an as-is valuation of Starbucks. Right? So this is a fully functional valuation model. Not too different than what people would actually use in Wall Street. Right? The only difference is this model is simple compared to the Wall Street models. Because if you're an analyst, you'll actually get even more detailed on your assumptions that you're forecasting for a company. For example, you'll forecast different business units, and then you'll sum them together to get the overall company. Right? But let's go back. So here's what I want to do. Starbucks on Monday was trading at $74 a share, $74.04. So I want to get very close, I think plus or minus $1 to that share price in our model. So how am I going to do that? I'm going to go to the ratio screen, and I'm going to also put in to my ratios equals for my DCF valuation, the forecasted share price, and my forecasted share price equals from the DCF screen 67.53. So the idea is I want to start to manipulate my ratios to get to the share price of the company, plus or minus $1. So in another way of saying this, I want to kind of understand what are the institutional investors thinking about Starbucks? What assumptions did they put into their cash flow models that actually justified the current price of Starbucks? So what is the market thinking when it prices Starbucks at its current price? That's what we're trying to do next. It's called the as-is valuation. Value the company, not what we think it's worth, but value the company based on what it's trading today. So the idea is we're working backwards to figure out what must the cash flows be to get to today's stock price. That's the process that we're going to go through. So the idea is very quickly in our model, you can see we can now do a quick change. If we grow at 14% a year, we're at $80 a share. If we grow at 13% a year, we're at $73 a share. And again, we're trying to get to 74. So I could have done that simplistically, but that's probably not what the market's actually thinking. Right? But that's what we quickly set up in our model. We can do a what if. So by the way, 1% change in revenue, notice that? Going from 13%, 12 to 13% is $74 a share. 12% is 67. 1% change in revenue, $7 a share. So I can start getting a sense of sensitivities of a company. 1% change in margin, 38.5, 37.5. About $5 a share. 1% change in revenue, $7 a share. 1% change in margin, about $5 a share. I can start doing this analysis $5, $6 a share. So I start getting a sense of sensitivities to changes in the statements, what it would essentially do to the share price. I'm going to undo that. But here's the thing. We're not the only people trying to forecast Starbucks. And the people that are also forecasting the ratios that work for the banks probably know more about Starbucks than we do. Right? And one of the reasons is if I go back to Bloomberg, ANR stands for Analyst Rankings. I can see that there's a bunch of analysts, about 30 of them, that are covering Starbucks. And here's a person from Sanford Bernstein, Sarah Senatore. And if I click on Sarah, I'll see that these are the other companies that she is covering. There's her phone number, there's her email address. She works for Sanford Bernstein. I've actually had undergrads call these analysts. They get very upset. But in any event, because they'll start talking to you and then they'll realize you're like an undergrad student at Smith and then they stop talking and they just hang up the phone. But in any event, this is her coverage universe. So she's writing research reports on these companies. That's her life. Her life is to know everything she can about these companies and write all the research. But that's the point. The people that are covering Starbucks probably know more about Starbucks' financial forecast than we do. So what I'm saying is why fight the trend? If they're the ones that Wall Street is also looking at when they're trying to make their decisions, because again, everyone's making similar assumptions, we kind of need to know what the wisdom of the banks are that are covering these companies. So here's what we're going to do. We're going to use, that's why I took a screenshot of the EEO screen for Starbucks. This is the current market forecast for the next 4 years for Starbucks. And what you'll notice is most analysts have 2 years worth of forecast. These are the number of analysts that are in the averages for these next 2 years, the consensus. Starting with year 3 and year 4, less analysts are willing to put themselves out there. Okay? And again, it's just kind of fear factor, because if you put in a data point, you're wrong, you lose your job. So why put data points in if nobody else is willing to do it? So very few analysts are willing to take that level of risk. So usually the first 2 years are the most heavily forecasted. So at least they forecast them, they just don't put them in the database. So back to this. But the first 2 years are pretty heavily forecasted for every company. This is the consensus. I don't think the companies are going to do that dramatically different than this consensus, because these people follow them for a living, and they would be as surprised as we are if the companies changed. But I'm just saying, we're probably not going to come up with, especially as novices, better forecasts than they have for the next 2 years, considering they follow these companies, talk to them all, do guidance and all this other stuff. So here's what we're going to do. We're going to use the first 2 years of consensus to help us value the companies. So specifically, what matters most in this consensus is the sales forecast, sales or revenue, and the operating profit forecast, because that's what's going to be key to free cash flow. So back to our model. What I'm going to do is in my assumptions tab, I'm going to put in an assumption for sales year 1, sales year 2, operating profit year 1, operating profit year 2. Year 1 is a convention forward year 1. Year 2, forward year 2. Okay? So in this case, 2014, forward year 1, 2015, forward year 2. Okay? So here's what I'm going to do. The consensus for sales in 2014 for Starbucks, 16,601. Let's see. And 2015, 18,396. Operating profit, 3068. 3623. That is the current consensus as of Monday for Starbucks, for what they're going to sell and what level of operating profits they're expected to generate. So what I really want to do is on my income tab, I want these numbers in 2014 and 2015 for revenue and operating profit to match the consensus. Except I can't directly change the income tab. I create the income tab through the ratios tab. So what I really want to do is I want to have the ratios that get me to these numbers. So how do I do that? Well, for 2014 revenue, I know percentage change in revenue is current year minus previous year divided by previous year. So here's what I'm going to do. Equals, I'm going to solve for it. Left paren, current year is year 1 assumption, minus previous year is off the income tab 2013 actual revenue, right paren divided by 2013 actual revenue. That is the percentage change that the market is currently expecting in revenue to meet the consensus estimate. Just kind of back solve for it. Could have iterated, but it was just quicker to solve. So now in my model, for my income tab, I am matching 16,601. I'm matching the 16,601 that's in the consensus. Just kind of solve for the percentage change. I'm doing the same thing for 2015. 2015 equals left paren assumptions, sales 2 minus sales 1 divided by sales 1. About 11% thereafter, 10.8%. So you'll notice that the market is not expecting them to continue to grow at 12% the next 2 years. It's going to start to slow a little bit. But here's the thing. That actually makes my stock price further away from the current stock price of 70 whatever, down to 61. Right? So that tells me that the market doesn't think that Starbucks is going to grow faster. And that's why they have a current share price where they do. The market probably thinks their margins must be getting better because that's the only way that you get more cash flow. So here's the next thing is we have to match the margins. So here's the idea. In the model for forward year 1, which is 2013 plus 1 plus 1 undo the formatting. Format cells general. This is the model operating margin that I currently have. 2014, which is my operating income as a percentage of sales. And this is the consensus. Consensus operating margin, which is operating profit year 1 divided by sales year 1 equals operating profit year 2 divided by sales year 2. So this is what the market thinks the margin of Starbucks is going to be for the next 2 years. And this is what we currently have in our model. So as you can quickly see, the market assumes that Starbucks is going to actually have better margins than what we are currently forecasting. That's probably going to raise their share price. So what we want to do is we want to match our margin model with the consensus. The consensus comes from the earnings estimates that Wall Street currently has on Starbucks. So here's what we're going to do. On the ratios screen, to match operating income, we'd have to either change depreciation, operating expenses, or cost of revenue. Now you'll see that I have highlighted in yellow cost of revenue. We're going to use cost of revenue as a proxy for all 3 of those. So rather than individually changing all 3, we're just going to change cost of revenue as a proxy. We could have changed operating expenses as the proxy, and our model, to be honest with you, doesn't care which one we change, but I'm just going to choose cost of revenue. Now I'm not going to choose depreciation as my proxy. Why not? Why would it be bad to change depreciation and amortization as the proxy? For matching the margin forecast of Wall Street. Well, depreciation and amortization is a non-cash item. So if I match Wall Street's estimates by changing non-cash items, I'm not going to get a right cash flow valuation. So I need to change one of these other 2. Ideally both, but I'm just going to use one because the model doesn't really care. So here's the point. I need to match this. So, fortunately, I can't solve for this without creating a circular reference. So what I need to do is I need to reduce cost of revenue by so in 2014 minus 0.0366 and then 2015 minus 0.0121. So I've now matched the operating margins for Starbucks. Now, if you think about it, what our valuation is most sensitive to is free cash flow. It's the operating value of the firm. Because that's really most of the value, most of the enterprise value of the company. And what drives free cash flow is gross cash flow minus gross investment. It's my CFI. What drives gross cash flow is NOPLAT. What drives gross investment? We've tied the balance sheet to revenue. So as the revenue grows, the balance sheet grows, the gross investment grows. So we're kind of forecasting gross investment. The real key is forecasting no plat. So what are the real drivers of no plat? Well, on our ratios, it's revenue, essentially the costs that go into the operating income, cost of revenue, and the tax rate. I think I have a reasonable tax rate for Starbucks going forward, so really it's the operating margin that I care about. That's why operating margin becomes the critical number. So there's 20 numbers on this page that we could change, but 3 matter more than anything else. Revenue growth rate, by proxy the operating margin, and the tax rate. Those are the 3 critical drivers that we have to forecast. That's the 90-10 rule. 90% of the valuation are those 10% of those drivers. You could forecast the other ones, but around the margin, how much receivables you have, it's not going to make much of a difference. Changes in your operating margin and growth rate are going to make all of the difference. So we're going to focus most of our attention initially on those 3 values. Again, if you believe other values should change, have at it. But I'm telling you, these are the most 3 important variables to any valuation. So growth rate, margin, tax rate, because those drive operating cash flows. Right. So back to this. Since we tied the whole balance sheet, like I said, gross investment is going to be tied to the revenue drivers of the firm. So I need to get very close to the current stock price. Current stock price says about 74. If I put in the revenue and margin forecast for the next 2 years, I'm at 82. Now here's the thing. If I look historically, somebody talked about historical data, the best margin Starbucks had historically is probably around 13, 14%, and they're getting up to 19, 20% operating margins in the next 2 years. It's pretty impressive. Question about sustainability, right? Same thing. They're growing at 10 to 11% a year. At some point, that revenue growth is going to slow as they get bigger. So here's the thing. If it slows to 8% a year, I'm at $68, and Starbucks today is at 74. If I go to a 9% growth rate, I'm already close to 74. So here's one of the arguments you can make for Starbucks. The growth slows, but the continuing value, because Starbucks continues to expand in other parts of the world, grows at 4%, not 3%, because Starbucks is tapping into the value of Asian growth. Starbucks will be tapping into the value of Latin American growth. So therefore, it's going to grow faster than a more mature U.S. economy. So I'll give them 3% into continuing. 3% goes to 4% in continuing value growth, right? Because they're going to grow faster than the U.S., faster than Europe, because they're in other regions that are growing faster. But that allows me to slow their growth rate down from 9 or 10%, which is going to be harder to do. But here's the thing: I'm now within $1 of their current stock price with this growth rate and that high margin. So that's 73.04. Starbucks is at 74.04. I'm within $1. I'll call that close to an as-is valuation. So I think somewhere in the mid-single digits is where Starbucks growth is going to be for most of the next decade at current levels of margin, and there's their current share price. And that's what we're going to call our as-is file, save as is valuation of Starbucks. So what we're really just trying to do is we're trying to understand what is the market thinking. Now what I could do is I could raise the revenue growth rate a little bit more, and I could lower the margin. I could decide if it was one of the two. But my bias is I don't think the margins are going higher, because when I look at the historical margins of Starbucks, they keep getting better and better and better and better. And I have a hard time believing they're going to sustain this level of better margins with competition. I mean, McDonald's is definitely going after them. with their McCafes, particularly internationally. I mean, when I go to Madrid, in whatever their main square is, one of their main squares, Plaza de Mayor, there's a McDonald's right next to Plaza de Mayor. And I have to tell you, it's one of the nicest McDonald's I've ever been into anywhere in the world. It's actually almost like a, I don't know, it's almost like a Starbucks. They've actually designed it to look like a Starbucks. They actually serve high-end coffee. They serve, pastries and other snacks in addition to the McDonald's stuff. A relatively nice seating area with couches. It's more dimly lit. But here's the point. Like, McDonald's is going after Starbucks. Dunkin' Donuts in the U.S. is going after Starbucks. Everyone is going after Starbucks. And at some point, is Starbucks going to maintain these margins? Are people going to keep paying all this premium price for their coffee and their other drinks? And maybe the answer is yes, but I'm a little bit more skeptical. So I don't think that the margins are going to get that much higher. I could be wrong, but that's the difference between a buy and a sell on Starbucks, by the way. Because I actually think that Starbucks, now we go between as is and final, I start to question these assumptions going forward. I think that they're too aggressive. I question whether Starbucks is going to maintain this level of growth and this level of margin into the future. And the only way they justify a higher stock price today is if they can do better than this. And I think that this is going to be as good as it gets for them. So here's what I'm going to do for my final valuation for Starbucks. I think that their margins are going to be strong, but if you look historically, the best they've ever done is 15%, which was last year, and then they're getting up to 20%. If they start heading back towards 15%, so after the first 2 years, because I don't want to change the first 2 years because I'm using the Wall Street consensus for this, but if this starts going to like 35, 36, and 37, so they get down to a 16% operating margin, their $61 stock price. So if Starbucks fails to achieve the operating margin improvements that Wall Street expects, and if their operating margins actually fall eventually to around 16%, which is better than they've ever done in the last 6 years, they can't justify their current share price today. So I'm going to put Starbucks on the sell list. That's Joe's opinion. I avoid Starbucks at this price. Shop there, enjoy their overpriced coffee like everybody else. Great store, don't own their stock. If it was $8 a share a few years ago, I think it was one of the buys of the century. I got Starbucks when they were really cheap. I could have made a lot of money off of them. But right now, I think Starbucks is probably a little overpriced. They have been fully valued. I may or may not be wrong. I may not be right. This is the point of view that we have to establish on the company. And we have to make it based on some facts and then the numbers that support the facts. And what I'm telling you is if Starbucks margin falls a couple of percentage points, 200 basis points, down to like 16%, there's $60 stock, even at 8% growth. And I have a hard time believing that they're going to maintain that going forward. So therefore, I say avoid Starbucks because I think they're worth closer to 60. I'm not saying I'm going to short them today because it needs to be fully realized because if they do improve their margins over the next couple of years, they could still see a little bit of upside in their stock price in the short run. But I think they're fully valued because I think that the price of Starbucks includes the upside of the margins. Because we can see if we leave Starbucks today at the 15% margin, their stock price is $67 a share. So the only way that Starbucks is worth the 70s is if they actually get their margin improvements. So I'm telling you, the margin improvements are already built into their stock price. And I don't see a lot of upside to owning Starbucks today. Now, again, they could surprise me. And they could, hit these margins even more, hit the growth rates and even more. And I could lose out. But I'm just saying it's a very dangerous stock. So this gets back to target price and buy, sell, hold. So if we come up with our opinion, so I go from the as is, which is backing into assumptions that get to Starbucks, to final valuation. So you always do two valuations. Final valuation is what do I think of those assumptions? Put in my own assumptions, come up with a final stock price, look at the delta between my assumptions and the current stock price. If it's within 10%, it's a trading range. Hold. If it's more than 10%, buy. If it's less than 10%, sell. I'm more than 10% below the current share price at 61. That's why I put him in the sell category. By the way, on Wall Street, no one agrees with me. On Wall Street today, there are 23 buys and 7 holds with an average target price in the 90s. But what I'm telling you is if we go through our model, the only way that they get to the 90s is if they get their earnings margins for the next 2 years and then they sustain them. So if they can get to 20% operating margins, pre-tax operating margins of 20%, and they can sustain that, where they're at 15 this year, 5 percentage points for the next decade, then sure, $90 a share, $90.95 a share. That's how you can justify a $90.95 share price. And we can see that in our model. So the Starbucks buy says, get this back up to about 20%. This is the number we want. Operating margin, close to 20%. So I want this to be back to around 33. By the way, 33, more like 30. There we go. So now we're talking about operating margins in the low 20s. So here's the other thing. Growth rate doesn't slow. 9%. There you go. Keep growing at 9%. Operating margins mid-20s. And there's these guys. There's this guy from Buckingham. There's DeFrisco. He could be right. It's a possibility. I think it's a dangerous possibility. Let's talk about what practically happens in the real world. In the real world, the markets and the analysts have hard time seeing past the next 2 years. It's almost like they have blinders from year 3 into infinity. The next 2 years matter. After the next 2 years, it's almost like they don't care. And I think that's how you end up with this situation. You see an overly optimistic valuation of Starbucks. And some could argue that this is momentum investing. There's a lot of people that want to own Starbucks right now because of all the improvement that they're about to get. And they just infer that they'll keep getting that improvement forever, and that's how it's easy to have a buy rating, right? But I'm just going to tell you, these same analysts, 3 years from now, are not going to have buy ratings in Starbucks because they're going to realize that they can't continue to get that level of improvement to justify that stock price. And most likely, they're going to have to cut their ratings. So could I miss out on $10 more of share price appreciation to stock price? Possibly, because it could probably go up as high as this. Just because there's momentum, and as they're every quarter keep getting better numbers, people are going to assume those better numbers will continue. But I'm telling you that, historically, and that's why this slide becomes so important. Where was it? When we did the valuation stuff, it's in lecture 1. That's why this becomes so important to understand that long-term ROICs tend to regress towards the mean. Long-term growth rates tend to regress towards the mean, law of large numbers. And I just don't think Starbucks is going to be immune to that. So, again, maybe they still have growth. Maybe Africa is going to be bigger than the U.S. Maybe South America is going to be bigger than the U.S. Maybe Asia is really going to be that much bigger. So maybe I'm missing out on all this growth that they're going to get in all these other regions. But right now, I just have a hard time believing that that's going to come true. So again, there's my more pessimistic view versus the optimistic view. They're different analysts. But that's what you're eventually going to have to do for your companies that you value. You're going to have to come up with your own point of view on what you think is realistic for these companies. That's the buy, sell, hold. You're also going to have to look at what the market must have been thinking to get to the current valuations, putting in the cash flow assumptions, and then explaining the cash flow assumptions that got you there. That's the as is. Questions? Does this make sense? So as I said, what we now have is a reusable model. Next Wednesday, we're going to reuse the model. So as I said, during next Wednesday's webinar, we're going to do another company, not Starbucks. And I'm going to post my as-is and final valuations files of Starbucks to Canvas, because you're going to use those as your starting points. But we could do the same thing and use this model for your companies that you chose today as well. Right? So again, let's stop our